All right, so I'm about to give it to y'all raw. The reason why I'm making this video is because I just spent the last 21 months in the stock market teaching myself how to options trade. I wanted to make this video because I didn't see any videos online at the time when I had started my journey that was just breaking things down for me in simple terms, but I'm sure they have more videos now. For the first part, it's going to touch upon some regular baseline type stuff, and then the second and the third part is going to be more so as far as the nitty gritty of the things that you need to pay attention to and keep in mind when you're navigating through these markets. So the first thing, as far as out of my entire list, as far as things to never do when options trading or investing, is being in a hurry to get rich quick. Now, I know this might seem like the obvious, but you could only imagine as far as the limits that people have pushed themselves to when it comes to overspending, being greedy, because they missed out on an opportunity or because of the opportunities that they see open. Just be patient about everything. Enjoy the process, enjoy the journey. I used to hate hearing that, but honestly, just do that because you're going to learn something new every single day. And every day that you learn something new, you're going to feel as if that you're getting closer to being able to accomplish what it is that you have set out on your heart. And I promise you, you will get there. Just do not be in a hurry to get rich quick. It doesn't happen overnight. It doesn't happen over the course of a week or a month. If anybody tells you different, they're either gambling or they just so happen to get lucky. So that's my number one thing. Number two, when buying options, do not buy options if you don't understand all the aspects and the specifications as far as the actual options chain itself. I've never heard anyone really preach that. I know people online, they might like talk about it, but fully understanding that options chain down to a T is what is going to make or break you. And that's understanding what side the calls are on, what side the puts are on, the strike prices, being able to spot when the spread of the strike prices change from $1 to maybe $5, looking to see what the open interest is as far as a certain option that you're looking at. I'm going to highly advise everyone out there, practice all of that with paper trading first. Set up a paper trading account before you jump into the real thing, and it'll allow you to trade virtual currency. So it's not real. It doesn't require any money. You can reset it or whatever, and you can get practice in like that. I would highly advise everyone out there who's curious to get into this game to at least do that part as far as due diligence on your end. You don't have to use your own money. Me, I was a different case. I just decided to utilize my own money because I entered this game with a thought process that if I use my real money, I'm going to learn, and I'm going to learn fast. I'm going to learn everything it is that I need to know. So essentially, I was putting pressure on myself, but it's only because that I knew that I would rise to the occasion and I would figure out a way as far as how to maneuver and figure out the information that I needed in order to get this thing down. So just keep that in mind. Don't jump into it unless you feel comfortable as far as how you maneuver through that options chain and you fully understand what it is you're selecting and you fully understand the buttons that you're hitting before you start submitting orders. All right, number three, and that's going to be not performing a technical analysis on companies and stocks of interest, specifically not understanding how to separate the company from the stock. There's going to be plenty of times that you feel as if it's a great company, but the stock has a terrible performance, or vice versa. You have to understand that the company itself and the stock aren't necessarily always going to be synonymous. It could be a horrible company, but they had great earnings, and you start to see an uptrend break out. Look at everything objectively before going out and executing whatever order that you want to go out and purchase or whatever. Just think of reasons why that order, that option might fail. Continue to think outside of the box and try to come up with things that you may not be thinking about. My next one is going to be buying options without looking at the economic calendar events for the week. So I'm going to give a quick example of this. And so for this one right here, you can go on Google and you can type in important economic calendar events for the week. And there's going to be some, I think even some .gov sites that'll pull up all the events for you. And you'll see like GDP or CPI data, jobs, retail jobs reports, and things like that. But a real life example of this, it occurred in September 2022. I was going crazy because I only been in the game probably like 4 months at this point. But I saw that the S&P 500 as a whole, it was set up for a negative move. What I forgot to do was to look at the important economic events for the week. And we had GDP data on that Friday. I had probably spent about maybe $35 to $4,000 on puts on SPY, and that was just basically me predicting or saying that I think that the market is going to enter a significant sell-off, which essentially I was right. The part where I wasn't right at is that I had bought my puts on SPY with an expiration date that expired Thursday, the day before GDP data was released on that Friday. If I would have paid attention and just went and looked at the economic calendar events for the week and would have annotated that on my calendar, that would have made the difference between me losing $35 to $4,000 over the course of 3 days and me potentially making anywhere between $8,000 to $10,000 over the course of 10-15 minutes. My next one is buying options on exotic companies or companies that just IPO'd. You don't have to think all outside of the box when it comes to choosing companies. Just keep it simple, whether it's an ETF or an exchange traded fund, or if it's any of the top 10 companies that support the S&P 500, Amazon, Tesla, Google, Microsoft, Apple, one of those. Just keep it simple. Just stick with those. My next thing, buying options on companies while studying its pattern of movement, then also understanding a stock's movement in increments. So the easiest way that I could explain this is stocks have personalities of their own. So now Apple, when you begin to study the movement flow of Apple, you'll start to see like on average on the day, Apple sometimes it might look like it's not doing a whole lot. It'll maybe bounce between like $1.50 to $2 or fluctuate back down. On good news, Apple might begin to move up between like the $4 to $6 range every now and then. But Apple's a sleeper, so look out for that one too. In comparison to Apple, you have a company like Tesla. A normal day for Tesla could be anywhere between a $10 to $15 move. If it has like good quarterly earnings or something like that, it could be anywhere between like maybe even not just 15 to 20, but maybe 20 to 25, just depending on what's going on. But the companies basically, or the stocks themselves, they're going to have a different flow of movement as far as like the dollar amount of increments. If you look at your ETFs like SPY, QQQ, those are going to be the two most popular ones that you hear about on average. Those might move anywhere between like $3 and $4. QQQ a little bit more. But just study the movement flow. And then the other thing too is just continue to go back and check the opening and closing price of the day or the median price. Okay, my next thing is buying options in companies without taking the current season into consideration. Also knowing when the stock's best and worst performing months are. So this is probably one of the most huge gems that you could probably take out of this entire video because it sets up the playing field for you. So if you think about it like this, if you just break the seasons down throughout the year, probably one of your most profitable seasons is going to be the holiday season. So around Thanksgiving and Christmas time frame. Thanksgiving, because that's when typically people start buying their Christmas presents early out, depending on whatever type of shopper you are. And then throughout the course of December and stuff like that. And then you have Q1 or quarter one, the previous quarter that closed out. They'll review the earnings for each company, depending, of course, if that's their time to report earnings. But I think maybe Amazon reports their earnings in January, if I'm not mistaken. So if you think about it like a company, if they were to report, not saying that they do, but if they were to report their earnings in January, that means that they're basically going back and making an assessment on the performance of the overall company throughout the last 90 days. So that's going from January back to December, back to November, back to October. So, and of course, like I stated earlier, if people are doing shopping, buying gifts, and all of these other things that Amazon has to offer, then you will be able to assume that, okay, Amazon, they're going to bring in a decent amount of revenue, some positive revenue and growth. And the only thing that has to match with that is a positive earnings call. So, and it could be the same thing as far as if you think about it, like the summertime. So if we're in January, it's January 2025 right now. And if I were to wait maybe till like February, March timeframe to start looking at airline stocks, because I'm anticipating a lot of people throughout the country to travel over the summer months. That's the other thing too, is just identifying the seasons in which stocks perform well in each specific season, whichever one it is that you're looking for. And so for my next one, it's not checking to see how the sector your stock falls under is performing overall. So the easiest example I could give for this is, like, let's say you see Exxon Mobil is up on the day, and it's probably been up throughout the last couple of weeks or so, and you want to go ahead and submit some calls on Exxon Mobil. Well, Exxon Mobil being one of those stocks that don't fall into one of like the primary sectors. It's in a primary sector, but I don't think it's like the top three sectors. The top number one sector I think is going to be like big tech. Then I think the other one after that is like the medical sector, or it might be the finance sector after big tech and then medical. But point being is that if you are looking at Exxon Mobil as its own entity and you don't do your due diligence to go and look and see what the top 5 oil, gas ETFs are, and then you see how the overall sector is performing and building up, you're going to lose money. So don't fall into that trap either. And then my next one is buying securities without a plan or strategy. And this could go both ways, whether it's for stocks or whether it's for options. If you're going to purchase any stocks or options, go into it with a plan. It could be anything simple. I know once you're getting started, you might say to yourself, well, what indicators could I use, or how would I know when to weave in and out? You can utilize the web application TradingView. In TradingView, it allows you to get an actual illustration as far as what stock it is that you're looking for, as far as how it's moving by the candlesticks. But you can also change your settings to implement other indicators on the platform itself. So if you're a person that is more of a fan of the aspect as far as following stocks or trading stocks based off of volume, there's going to be volume indicators on there. You can use, like, I think it's the VRP, or there's going to be the volume weighted average price, the VWAP. Or if you're a person like me, I like to look at the moving averages. I think it's the 20, the 100, and the 200 moving average, or I think it's the 20, 50, 100, and 200. But also, too, you got to look and you got to ask online, and you can either ask Google, or preferably I'd ask ChatGPT, because ChatGPT will give you more of a definitive answer. But you can look at like what are the most accurate moving averages, but just finding whatever your niche is going to be and then sticking with it and then believing in whatever strategy that you're going with. And my next one is getting frustrated when a trade does not go as planned. Understand that there will be times to where you experience losses. Trying to avoid experiencing losses is just not a thing. That's even with utilizing a stop loss. Like, yeah, you might lose out on a percentage of your money, or you might save a percentage of your money, but essentially you still lost a little bit of that money. Just understand that losses are a normal part of this game, just the same way that gains are a normal part of this game. But the most important thing that you need to ensure that happens is that you make more than what it is that you lose throughout this entire process. So just continue to strategize, continue to, if you were able to do an in-depth risk analysis, whether it's on your own, or if you're using some sort of tools inside of your web application or your trading application, just do some sort of analysis to try to avoid losses in general, but just don't be surprised when that occurs. My next one, revenge trading, or what they call the get back. Don't do that. I'm at a point now to where if I have a bad trade, whether that be on a stock or option, I don't even look at the markets for the rest of the day, because I don't want to be tempted. And this goes into the human psychology aspect. I don't want to be tempted to see the amount of money that I still have in my account, and I'm thinking like, oh, okay, I can go ahead and redeem myself for the loss that just occurred. I don't even want to do that. I'm at peace with it. I let it go, and there's going to be another day. Matter of fact, you want it to be a situation where you can survive to fight another day. Just go ahead, be at peace with it, re-strategize, and then go back at it. The markets are going to be open the next day, so you're going to have another chance. And just don't fall into that trap, because a lot of people do. And then I already talked about it earlier, but just to reiterate on it again, as far as not understanding human psychology when it comes to the aspects of money and greed, especially when you're starting off. The average person that starts off, they might be a little greedier compared to like a seasoned trader and investor, just because they're in the mindset as far as, okay, I have this machine or I have this thing that I can utilize to make money. Well, I need to hurry up and make as much money as I can so I can quit my job, or I can go out and buy these shoes for this event that's coming up or whatever. Just don't go into it with that mindset or that aspect. And that's for everything in your life. And then this one right here, nobody told me. I didn't hear anyone mention this online. This is just something that I did because I noticed that it helped me out. It helped me out as far as keeping my peace within, but using the same account for buying options and holding long-term stock. So I was doing this early on and didn't think anything of it, but it came to a situation to where I ended up having a bad options trade, but I had some long-term holdings off to the side. And I sold off a little bit of the shares I was holding. I think I was holding like shares of Tesla or something like that. I sold off some of those shares so I could jump back in and get back on the field options trade. What I personally do now, I keep the two accounts separate from each other. So like I have E-Trade, that's for my long-term holds with all my stock. And then I'll use Thinkorswim for my options trades. My next thing is being easily influenced or being subject to panic selling, FOMO, or fear of missing out, or just being tricked out of your position because you fell for a false market narrative. So this happens all of the time as far as people being easily influenced, as far as somebody like yourself who's just getting into the game because you don't know a whole lot about anything when it comes to options trading. So whatever you hear on Bloomberg or Schwab Network or Squawk Box, as soon as you start hearing the analysts on there talking about selling pressure, all this other stuff, you're gonna clear your account out, sell everything, and keep your money. And then a few days later, the market's gonna go up on you, and you're not gonna be able to buy back in on your stock, or you missed out on profits on options that you could have jumped into. So a big thing with that too is going back and is doing your own research, understanding why markets move and understanding what moves inversely with the markets. And what I'll say with that is like paying attention to things like the 10-year treasury yield, things like Bitcoin, something that's huge that can tend to be a catalyst as far as market movement. Paying attention to the volatility index or VIX. You'll hear that one a lot, but start paying attention to those small things. And really there's only like, well, I'm not going to say there's only, but there's like 5 things that are heavily weighted as far as like which direction the market may be heading, as far as like what can give you some signs so you can better gauge how to position yourself. So my next thing is going to be not backtesting the stocks of interest. History does not always repeat what it does rhyme. So that's just doing technical analysis, historical analysis, going back, seeing like, oh, okay, well, if this report comes out on Friday and people think that it's going to be negative, let me go back and see how this specific stock or this ETF performed the last time negative news came out, seeing if it moved like 1% or 2%, or if it had a huge sell-off. Just things like that. And you'll probably spend the majority of your time doing that if you're at least trying to get it to where you make more accurate and precise trades. But that's going to be one of the best things that you can do as far as just making sure everything is smooth on that end. All right, now we're going to jump into the nitty gritty. So first thing, as far as my things never to do when options trading, is submitting orders on options the first day of the week or as soon as the market opens. So the first day of the week, one, sometimes you may not even be able to do that because something like a gap up might occur. So there might be like a sell-off on a Friday and then a gap up on Monday. Well, you can't get in. So, I mean, it is what it is. Or jumping in as soon as the market opens because there wasn't a gap up, you'll begin to get to a point to where you just want to analyze how the market is moving a little bit. I know some experienced traders out there, they like, I think it's referred to as like range trading, or just seeing what range the market is flowing in. So they'll wait about like anywhere between 10 to 15 minutes just to kind of gauge where it's going. Because those first 10 to 15 minutes, those are going to be some really volatile moments. And you got to let that settle out to see, okay, where you think the market is going to go for the day. So definitely do that. Once again, it's not a rush. It's not a rat race. It's not anything like that. It's just straight patience and strategy. And as long as you utilize those two things, you'll be successful. All right. Now, this next one is huge. This is free game, a free gem. Matter of fact, multiple free gems. It took me a minute to find and understand, but buying in the money, at the money, or out the money options without knowing what their specialty is best suitable for. I say this because I know when you look at that options chain, I don't even think it has it listed on there, but the deeper you go, because you'll have that median part, and the further that you go up top, that'll be your deep in the money options plays or options calls. I'm on my left side because that's how TD Ameritrade has it set up. But that'll be my deep in the money options calls. And coming back down to that price range level, that'll be my at the money options calls. And then going further below down to the base will be my out the money options calls, and then vice versa on the right hand side as far as puts go. Now, I never had any considerations as far as like one being better than the other. I just knew that I was looking at the screen and they were different. I didn't really know or understand why these were different until once again I found a random video on YouTube after spending hours trying to figure this thing out. And the best way that it was explained to me was that deep in the money options are better for modest moves. Nothing crazy, but $3-4 here or there, like that's good, because the other thing too is a deep in the money option is gonna have a higher delta, and a delta is just how much you're making profit for every $1 move on that stock itself. And the deeper that you go, because the delta goes up to like 1.0, which is supposed to be the equivalent to 100, because that one contract represents 100 shares, and then it'll go back down to anywhere between like 9.1 or 90 and then 80 and so on. But for every $1 move, that'll be anywhere between like 100 or it could be 90, depending on which delta that you go with. So the next one is going to be at the money. At the money, I'm thinking back on it now. I think I had looked into this on ChatGPT for a more definitive answer, but at the money options, it's going to be in that median range on your screen. It was listed as far as being good for large anticipated moves, or i.e. earnings calls. And I think it had it listed as far as being good for large anticipated moves just because you can buy more options for a cheaper price compared to deep in the money. But I think deep in the money would be good too if you got the money for it. And then you have out the money, and that was listed as far as being better for long-term plays, or what's called leaps. I can't remember it at this time as far as like what the acronym LEAP stand for, because it does stand for something, but that's going to be plays anywhere from like a year out, 365 days out or more is going to be your leap options. But other thing too is, because I don't know if I mentioned it on here in my notes, but I'm gonna go ahead and just say it in the event that it's not listed on here. But the other thing too is with understanding your, matter of fact, I'm gonna say that for last. Yeah, we'll swing back to that. Next is buying options right before an earnings call without comparing the premiums to the previous price. Now, this is important. And once again, this is one of those things where it's like, hey, if you don't know it, you don't know it. This is important because if you don't pay attention to the premiums and the options that you're going for, you're going to completely miss one of the best lessons that you'll ever get in this market, or one of them. So if there's a lot of anticipation for, like, let's say NVIDIA's earnings report is coming up, or they're about to have an earnings call, quarterly earnings review over the past 90 days, earnings are like in 2 weeks. Well, you wait last minute and you buy some calls on NVIDIA the day before they're supposed to release earnings, not comparing the premiums over the course of that 2 weeks leading up to that. You're gonna miss the fact that the premiums have only been getting more expensive. Now, as the premiums get more expensive, one, you're gonna spend more money, yes, but two, the thing that's gonna occur right after that, sometimes the premiums went up in price. NVIDIA did their earnings call. Yeah, they had good revenue. Yeah, they had good growth. But like, let's say the earnings call itself, that 1 hour call that you sit in, you listen to on the CEO speak, and the COO and all of those other people, if they are projecting like a decrease in sales for the next quarter, if they say anything negative on that call and NVIDIA ends up going down in price, or they sell off like $10 or whatever, now it's not a situation where you're gonna lose out as far as the money on like your theta or your time decay, but it's going to be a situation where you'll get hit with the term a volatility crush. So I think that had happened to me before, and I had no idea why it happened, because I was like, yo, I lost way more than what I expected, but that's one of the reasons why. So that's free game for y'all. Nobody ever broke that down to me like that, but that's one of the reasons why that can still occur. And then, so my next thing is not checking the trading direction on all three charts on whatever stock it is that you're looking at. And when I say all three charts, I'm talking about the yearly chart, the hourly chart, and then like the 30-minute chart. So another thing too, being fresh into the game. And I think, and really, I wish I would have said this earlier, but I'll say it now. I I'm trying to get it to where people recoin the term, as far as not using the phrase options trading, or not options trading, but more specifically day trading. Because when I came into it, always hearing the term day trading, what does that do? That puts you in a mind frame that, okay, I'm day trading. Like I have to day trade because it's day trade. You do not have to day trade whatsoever with your options. You can purchase options with an expiration date that's 3 months out, that's 6 months out, that's 9 months out. Yeah, it's gonna require a little bit more money, but that's also gonna give you some wiggle room for error. So if you purchase at the wrong time or the wrong week or whatever, you still have time to not only recoup that money, but also get some gains out of that sale and still make a profit. I went in thinking otherwise, and that's one of the reasons why I ended up losing a significant amount of money like within the first 3 months. So just avoid that altogether. And my next, but yeah, also too, I just want to say again, pay attention to all three of those charts, because I don't think I swung back around to that. But all three of those charts, the yearly, the hour, the 30-minute, just to be more specific, if you're utilizing the 30-minute chart to trade options and you're not looking at that hourly or that specifically that yearly, it could easily be a situation where that yearly chart is going in a downtrend, but you purchase calls on a 30-minute chart. That is the case, you are going to, depending on like if you are gonna weave in and out, or if you had the intention to stay longer, you're gonna end up losing that money. So you need to look at all three, see what all three are doing. So if you see that on the yearly chart, the stock is in an uptrend, on the hourly chart, it's in an uptrend, but on the 30-minute chart, it's in a downtrend. Well, after you do your analysis, it could be a situation where you're like, okay, it's in a downtrend now, but this looks like a good opportunity for me to go ahead and buy this dip. Or if you deem it to be a dip, not saying that it's going to be a dip, but so keep that in mind. I almost missed that one. And then my next one is submitting orders. I mentioned this early, but now I'm going to highlight it. Submitting orders on options with $5 spreads between strike prices. So stating earlier, as far as like fully understanding the aspects of the options chain, one thing that happened to me, I think I had purchased the option one time, but I wasn't paying attention to the fact that the spread on the strike price had changed. So when you look at that options chain, you're going to see all the prices going down in that center column. I had been used to seeing $1 spreads. QQQ, SPY, Apple, a few other companies. I'm always used to seeing $1 spreads. And I had purchased a call option and I wasn't paying attention, but the $1 spreads had changed to $5 spreads. So, I was locked into the trade at that point. And I think I just ended up getting lucky because I still ended up profiting because there was like a large move. But, that's one of the other things too. Like if you get in on a $5 spread, one, that expiration date better be at least 90 days out. And then two, there better be like significant momentum going into that stock and having it go up in price. But I had got in, I was looking, and I was like, okay, well, why did that spread change like that? And going online, I think it was on Chat GPT specifically, I had looked, and it's just basically if there's a certain change, like energy in the market, like if there's some uncertainty in the markets, or if people are expecting like something huge to come out, or like a sell off, and that could be just due to like a bad inflation report or anything like that. If there's any anticipation like that into the markets, please believe that the spreads on those options will change. And then understand too that you can go back and you can ask ChatGPT as far as like how often do the spreads change, and then for how long do they remain like that until they revert back to like a regular $1 spread or something like that. So continue to maximize the amount of questions that you have with AI, with ChatGPT, and all these other great tools out here, because the majority of them, I didn't have them. or I wasn't aware of them when I first got into the game. You know, like 2020, what, 3? Because it was a 21-month journey. Like, granted, the stuff, it was probably out there, but the applications, they weren't as advanced as they are now here, January 2025. So my next one is going to be manually submitting your orders and not utilizing limit orders. When I say that, because when you go in, and this is the same thing for stocks too, when you purchase these things, any of these securities, you purchase an option or you purchase a stock, you could either do like a regular market order, and that's whatever it's going for, whatever range it's at, or you can be more specific and do a limit order, so you know the exact dollar amount that you're going to get into. I think starting out, I wasn't using limit orders so much. It wasn't until like later on, or I may have been, and I probably just wasn't paying attention, but it wasn't until later on to where it was like, okay, I'm gonna either use limit orders, or I'm gonna really try to automate my trading and go off of levels and just do my pricing like that. But yeah, don't do a market order, because a market order, depending on what the opening or the closing or what the median price is, the market order, it might get you in at a high price, and you might end up spending more money for whatever security that you're trying to purchase, whether it's an option or some stock. But utilizing that limit order is going to prevent you from spending more money, even if it's only like a few, like $5 or $10 more. It's just still the fact that you're spending more money to purchase a security, when you can save that money and put it elsewhere or use it for another player, something like that. So just keep that in mind. And there's tons of videos out there on YouTube that's going to show you how to do this. The majority of the things that I'm telling you right now, if not, there's some verbiage that breaks it down for you to where you can try it out step by step. And then also too, this is free game, but for whatever you're trying to do, and I know a lot of people, they overlook this one because nobody's talking about it. You're not gonna be thinking to do it, or you're not gonna do it. Is if you have any questions as far as what it is that you're trying to do on when you're submitting your orders, or you're through that web application or that brokerage exchange application, 9 times out of 10, they're going to have a support team, a trader support team. You can give them a call, and they're going to have experts online or on the phone that, you can explain what it is that you're trying to do. And then they're going to go ahead and they're going to lace you up right. And then they're going to help you out and get you to the point where you can go ahead and do whatever it is that you're trying to do. Unless it's something crazy and it's just not possible on that application. And understand too that certain applications or certain exchanges, they're going to offer different services to where, there might be some things that you could do on E-Trade that you can't do on TD Ameritrade, Thinkorswim, and vice versa. And that actually ended up being the case for me, because one strategy that I use on Thinkorswim, I couldn't do it on E-Trade. I had called and talked with the trading, I think it was like the advanced trading team with Thinkorswim, and then they was able to walk me through it. And then I called the trading team. I think E-Trade had a trading team where they just had like a regular support hub. I called them and I asked them, am I able to do this on here? Do y'all have these features? And they told me that they didn't. So just keep that in mind. But yeah, just don't hesitate to reach out and call somebody and ask them, in the event that, you don't have a mentor, you're starting in fresh or whatever. This is why I'm putting this information out. And, next thing, I had briefly touched up on it, but utilizing the stop loss. And you can set that anywhere. I think average trader or seasoned investor, they put their stop loss anywhere, at a point where it's like 20 or 25% loss. So the moment that they lose 20 or 25%, they automatically get up out of that trade. Do that, prevent yourself from losing money, but then also too, just make sure you keep an eye out and you don't get stopped out of that stop loss, because I've seen that too. And that could be something simple, just based off of, a spike in movement, whether it's whatever news, it could be a spike to the downside, and then it just, for whatever miraculous reason, starts going higher to the upside. I've seen it happen. So just be careful on that. Then my next one, this one right here, I love it because it was something that I don't think I ever heard anyone talk about, or at least I couldn't find it online. But gap trading. I believe gap trading is an actual term, but so I'll give a real life example as far as gap trading. I believe it was January 2024. I think I did like a put option on Costco, which was a huge mistake. One, I wasn't paying attention to where the overall market was going. And then two, I don't think I had all three charts pulled up on Costco. That was another mistake on my part. And then three, I didn't look up more as far as the actual aspects of utilizing a strategy like gap trading or gap ups or gap downs. But I was looking and I was thinking like, oh, okay, like I see that Costco gapped up right here on this chart. So it's gonna have to come back down and fill that gap. Well, it wasn't until I had went and did further research and I had saw that gaps only fill 70 to 80% of the time. Gaps do not always have to fill. Now, is it going to be a higher probability that a gap is going to fill in the event to where a stock falls down in price? Of course, because overall the market is a forward-looking mechanism and the market is going to continue to move in a positive direction over time. I was looking at it from the aspect that, oh, Costco stock had a gap up, so eventually it's going to have to gap back down. No, not necessarily. That right there, yeah, I think right after that, it was just positive going straight up. So it didn't go back down. So you could probably leverage some gap ups, definitely. SPY, QQQ, they tend to have some gap ups, especially like if it's depending on what time frame it is or what's been going on. Seeing SPY or QQQ having a gap up on a Monday morning after 2 weeks of selling is not an uncommon thing to see. So just looking at gaps, pay attention to gaps, because sometimes you could profit money off gaps depending on how the strategy that you're using with your trading, whether you purchase some options on a Friday, like an hour before the close, because there's going to be some heavy selling going on, and then you end up profiting on that Monday when the stock gaps up like $3 or $4, and you can go ahead and sell, and that's your money for the week. So just pay attention to those gaps. Those gaps got me off that one play. My next thing is buying options with less than a 3-week expiration date. Now, coming into this game fresh, like never, trading in general, period, or if you only paper traded for a little bit and you're like, oh, okay, I got this. Even still, just get something that at least has a 3-week expiration date. Going back to the example that I gave earlier, as far as buying those puts on SPY in September 2022, when we had that bad GDP report with the sell-off shortly after, if I would have had something simple, and really I didn't even need 3 weeks, I only needed like a week. But if I would have had it to where those puts that I had bought had that 3-week expiration, once again, that would have made the difference between me losing $3,000 to $4,000 or $3,500 to $4,000, and that would have made the difference between me potentially making anywhere between $8,000 to $10,000 in maybe like 15 or 20 minutes. When you're first starting out, you're gonna look at those 3-week expirations and you're like, I'm not really trying to pay that premium. I'm gonna try to be cheap and stick to my 1 or 2 or 3 day expirations because they're gonna be way less in price. You don't have to go that route. Don't go that route, because as soon as you lose all of that money, now you're gonna be, oh, okay, I need to wait, for 3 or 4 more paychecks, and so I can get back into the game. And now you losing gains when the market's on an uptrend. So don't try to go the cheap route. Just continue to play it strategically in the best way that I can put it to you. I don't know if I had mentioned it already earlier, but before you could play short, you got to play long. And even when you're playing long, you're still playing short. So hopefully that makes sense. I'm playing short in the aspect as far as like taking your profits when you're playing long. So if I do calls on NVIDIA and it has a 6-month expiration, but it just ran up like 5%, oh yeah, I'm gonna sell and I'm gonna buy back in, because I was in a position to where essentially I was playing long, but I was able to benefit off of a short-term move. And I'm gonna continue to strategically move like that as the stock is in that uptrend. Now, next, my last thing that I said I was gonna hold off on, because this was like the bread and butter right here. Like I had to travel to Earth to get this answer, like literally. But buying options specifically, this was for me. This may not be for you, but for me, this was the answer that I needed. Buying options with a delta less than 70, and then also understanding the majority of the time that you can find that delta of 70 about $10 below the current trading price of that stock or option. So for me, I think I was buying options with like a 3-month expiration or a 90-day expiration date, but I think the delta was maybe like below 60 or something like that. And because my delta was below 60, if you look at that 9 times out of 10, anything really below 70, the theta is going to be higher on that. So for me, my strategy as far as swing trading, because that's more beneficial for me because of like the hours that I work. I'm not always able to be on my phone and things like that. So for me, I was going about it that route because that's what worked best for me. But during that period, I noticed that like, okay, I'm playing it safer, but I'm still losing money and I didn't know why. I didn't know why because I didn't understand the full aspects of that options chain, and I didn't pay attention to the fact that the lower that you go with the delta, the higher that your theta might become. And I don't think that's like the case for every situation, but for my case, my delta was lower, but my theta was a little bit higher. So essentially, me going that route or that method as far as a swing and holding it for at least a period of 90 days, it was a little bit counterintuitive because I was going to lose more money for each day that I was holding that option just off of that theta, or what's referred to as that time decay. So in order to protect me from that time decay, and watching some videos online, I watched a video of a guy and he just basically broke it down like a delta of 70 and really 70, but anything higher, of course, yes, it's going to be great, but a delta of 70 specifically is probably going to be the lowest that you want to go, and it's probably going to be the sweet spot for you because the theta decay price is not going to be as high, and it's not going to burn on you as quickly or burn your money as quickly as what it will to anything like below 70. So that right there is the bread and butter. I can't break it down any more better than that to you. Hopefully, I didn't do a horrible job delivering and going in depth and breaking this information down to you. This is a hell of a lot more than what I had got coming into it, because I don't think that I've came across any videos online that have broken this information and given information out like this down to the point to like I did. So hopefully all you out there, just make sure that was everything. Yeah, that was everything. Hopefully all you out there that's curious to embark out on this journey, hopefully you got something from this video, whether it's only one thing that came across you from this video that you're like, oh, okay, I'm gonna take that with me, or if it was nothing, it is what it is, but just go ahead, like this video, send clips, to anybody that that's actually trying to get into this. If there's anything that I talked about in this video to where I left some details out or I didn't describe it in the best manner that I could, you can go ahead, drop a comment or whatever, and I'll go ahead and do that. I don't wear my heart on my sleeve. It is what it is. But, once again, this was a review of the 21 months that I spent teaching myself how to options trade. And once again, I just want to reiterate and specify, like, when you're going in on this journey, it's going to be lonely. People might be looking at you like you're crazy. If you have the opportunity to do so, I'm going to recommend that you do something that I did not do, but I wasn't in on any investors or traders groups or anything like that because I wanted to teach myself all of this so I could be self-sufficient, self-reliant. But I know that's not going to be the case with everybody. So if you're able to get in on one of these groups, which they got a ton of groups out there, whether it's Honey Drip with Aristotle Investments, or I think it's Trappers Anonymous with Wall Street Trapper, and then you got EYL, Earn Your Leisure. If you can get on one of those groups or any other groups, that you have witnessed be successful or that you've heard about or anything like that, get in on those groups, because they'll have more information for you probably than what I've given to you, because they're more experienced in those areas. But 21 months ago, I know it doesn't seem like a long time ago, but like all the information that I was looking for to get to this level, it wasn't out there. And then also too, I'll go ahead and give it to you because I know people are probably thinking like, oh, okay, well, what's your account at right now? So everything that I've given to you, I just seen it come into fruition this past November 2024. So I saw that Apple was forming an ascending triangle on the yearly chart. And at this point now, paying attention to patterns and, candlestick movement, I was like, okay, Apple, for whatever reason, is poised to have a significant move. I don't know if they're going to come out with something about AI phones or anything like that, but I saw the ascending triangle form up. I bought off the 100-day moving average. I think I had went in probably like 6 calls or something like that, and I held them for maybe about no more than 29 days. So I bought them around early November. And then after 29 days, I ended up selling because I ended up profiting about a little over $9,000. And I'm gonna tell you right now, that was the fastest $9,000 that I made throughout my entire life. And the only thing that I had to do was trust the process, trust my strategy, trust that I know the information, and I remember everything that it is that I learned, and just wait over the course of 29 days. In doing that, it brought me to a $9,000 plus bag. And then I think a couple weeks after that, ticker symbol for Broadcom. Broadcom came out. They were about to have earnings report coming out, and I had set my order to where it was like, hey, if they have a significant earnings report like I think they're gonna have, I'm gonna go ahead and get on a couple calls. I wasn't trying to go too crazy because I just got the $9,000 bag with Apple, so I was like, I'm not trying, lose any of that money. But I think I had just did like 2 calls on AVGO, and I think I got in around maybe like, I think it was trading around like either 189 or 192. I forgot which level it was, but I had got in on that level, and it jumped up to like 215 that next day, or at least 215 is the level that I sold out at. And then I think throughout the day or the next day, it continued to go up in price, and I think it ticked anywhere between like 225 to like 232 are the levels that I was looking at. So I'm at that point now to where, after going through the mud for so long by myself, that I was able to see the end result. So trust the process. It's not as hard as you think it is. The hardest thing is going to be, just trusting yourself and being patient and going through the motions, and continuing to just try to find holes in your game. But after that, you'll start to get to where it is that you want to be. Continue to save money. Just continue to put that money aside in your accounts. Because depending on like which brokerage exchange you're on, I know like Thinkorswim, as soon as you deposit money over there to your investment account, I don't think the money is going to clear to where you can actually utilize it to trade options until like maybe 5 to 7 business days. So just continue to put money to the side, stay ready for any, changes in the market. And that's the same thing too. Like, you don't have to do it like this, but if you're doing it like me, to where you got 2 investment accounts, keep them accounts loaded up. So anytime something, gets cracking, you can go ahead and jump in and make moves like, the hedge fund companies be doing it, and folks like that. But yeah, just pay attention to that. Pay attention when, money's getting liquidated out of the markets and things like that, and you'll be golden. But once again, try to keep this video short. I hope I was able to break it down to y'all in simple terms, to where you could get the feel for it and where it motivates you to go out, start taking notes and actually trying to put the things that I mentioned into action. And I'll see you on the next one, man. Peace.